I want to introduce our next speaker, and he'll talk a bit about himself and do the formal introduction. But we joined National Bank Financial. Somebody asked us this today in 2002, and Ralph and his partner Michelle Falk were two of the first people we met, and we've always had a lot of respect for them. They've had increasing roles at the firm, and then have now started their own firm. So we're happy to partner with them and use their expertise and their service to help us make a difference in your portfolio. So with that, I'll hand it over to Ralph, and thank you very much.
Thank you, Paul. So you can go to my first slide. I'm going to be talking to you, and I think most of you, from what I've learned, own what we call the MAC basket in our jargon. It stands for the multiple asset class basket. So I'm going to be talking a little bit about that, give its history, because I was around when this product was launched almost 10 years ago. But I think the real reason I was invited to come talk was to give a little bit of an overview of what our views are on the market, and then how that relates into the strategy that we're feeding into the investment product that we are managing. I'm going to be talking about the free lunch of investments, which is diversification. There's not a free dinner, but you have a free dinner. I'm going to try to keep this short. It's not free for me because I have to do a little bit of work. I'm going to try to keep it short, but please, it's supposed to be informal. If there's any questions along the way, please do not hesitate to interrupt me. My firm is a brand new firm, only been in existence less than a year. FNB Capital, it's ironically the same three letters as NBF, and no, I'm not dyslexic, that is the name. We have no affiliation with NBF, although I worked almost 20 years at NBF, and the co-founder of FNB Capital with myself, Michelle Falk, managed almost 30 years at National Bank Financial and National Bank at the end. But besides that, the name is actually the French acronym for an ETF. In French, they call them the Fonds Négociés en Bourse, so an exchange-traded fund. ETF Capital, unfortunately, was a name that had already been taken by a Toronto-based firm, so we did the next best thing and chose the French version, and waiting for them to sue us for stealing their name. Before this is a good one. This is a code here. I don't know if there's anybody that's a Unix programmer. This is something I learned. And does anybody know what TADIW is an acronym for?
I'm waiting for Steve to answer.
So apparently this is ingrained in the Unix programmers. They would recognize this right off the bat. Do one thing and do it well. And so if you hit the button, actually, Steve Jobs said it a little differently. Do not try to do everything, do one thing well, and that's what Apple is known for. The reason I bring the quote up and the acronym up is we only do ETFs. It's in our name. We're a small firm, 3-man operation right now, and we would not be credible if we went around saying we are picking stocks or we are picking bonds. We would need a huge research team to have some credibility on that. But we are experienced portfolio managers. Between myself and Michelle, almost 60 years of portfolio management experience. And we use that to build portfolios using exchange-traded funds. And I'm assuming everybody knows what an exchange-traded fund is, but I'll give the 1-minute definition. Basically, an exchange-traded fund, think of it as a mutual fund. It's a managed product, but the big difference is it trades on a stock exchange. So you can buy it and sell it like you would a stock, but it's going to behave and the performance is going to be related to what that exchange-traded fund owns. In the old days, when we launched this back in 2005, most of the exchange-traded funds were simple indexes. So you could buy the TSE 300 in those days we call it, or the S&P 500. You could buy, just like buying one stock, you would effectively own the performance of an entire index. It's a place that's grown tremendously. Now there's something like 2,000 ETFs just in North America with something like $2 trillion invested behind them. And now it's gotten very complicated because you can, whatever flavor of investments you want, you can now have it with an ETF. So as an example, if you wanted to only have small caps companies, there's an ETF for that. If you wanted to have dividend paying companies, there's an ETF for that. If you wanted to have ETFs that are hedged in terms of their currency risk, you can have that. So the sky's become the limit, and it's allowed us to be very credible in presenting complicated portfolios, good performing portfolios, using an instrument that has really come of age. You might have noticed it when had the logo of FNB Capital that in our logo we have 4 little hexagons. And what we realized is we're very much like the honeybee. We're putting together pieces. And I remembered something from my grade school science that wasn't there something special about putting hexagons together? And in fact, mathematically speaking, it's the structure that allows you the greatest strength and the greatest storage space for a given set of materials. And there's a mathematical proof behind it. And we said, wow, that's a nice little concept that we could use, because that's what we're doing. We're putting together different asset classes and trying to create a solid structure. And we said, well, if it's good enough for the bees, and if it's good enough for aerospace engineers, because until they started making planes with carbon fiber, the aluminum planes were all honeycombed inside. And if you took apart the aluminum, you would see little honeycombs for that very reason, that they're very strong. I skipped over talking a little bit. I mentioned that I'd been almost 20 years at National Bank Financial. My background was, I started in treasury management. I grew up in Montreal, was working in Toronto, did my MBA overseas in France, and then was working for Honeywell, a large multinational, but always had an interest in investments. And that's when I decided when I came back to Canada, did my CFA, and I've been hooked on the investment world ever since. So as I said, I spent almost 20 years at NBF. The last 5-6 years, I was the senior portfolio manager of the high net worth group. It's called Private Wealth 1859 at National Bank Financial. And just really for personal reasons, about a year ago, I decided to take a break and left on very good terms. But I left without having any set plans of what was going to happen next. And I was actually in Europe over last summer, when I found out that Michel Falk had also left the firm. He, at the time, was the president of National Bank Investments. And Michel, long career at National Bank Financial, was then the CIO of an investment firm that National Bank used to own called Natcan, which got sold off to Fiera. And so this is the sort of the whole story coming full circle. The Mac Basket was launched by myself and Michel Falk back in 2005. And then over the years, it ended up being, because of the mergers and the changes, and it ended up being in Fiera's hands. So Fiera was the manager of this product for the last 3 or 4 years. And when I met up with Michel and we had this crazy idea of launching a new management company, one of the things we thought we would have a chance of winning was the Mac Basket, because we were the founders. And not to say anything negative against Fiera, who are great portfolio managers, they just didn't have a real expertise in the ETF world that we thought we could bring. And so we made the pitch to National Bank, saying, we're a new firm, and as sort of the founders, this Mac Basket is our baby. We think there would be a good fit, and lo and behold, we won the mandate to start remanaging this product in January. And so far, so good. I'll show you the numbers at the end of the presentation. And I think what we're bringing back to the table is sort of the roots of this product again. When it was launched, I think you can go to the next slide. When it was launched, I'm hearing music now. Is that a sign? Is that a good thing? Is that a good thing?
The Oscars. Reggie's dance card is full.
I promised to keep it short, but that was a bit unrealistic. So what happened was in 2005, as Martin Luther King had his dream, I'd like to say it was my dream, but I can't attribute it to myself. But there was this dream that portfolios could be managed better. And part of it came from looking at what the so-called smart money was doing. You often hear that term in our business, the smart money, and that's the institutional money. But when you actually look at it, the smart money, they do the same dumb human mistakes that individuals do as well. You know, feed and greed affect the institutional manager just as much as it does an individual investor. So sometimes I was a bit skeptical that there really was such a thing as smart money. But when we looked at it, there was a few areas where things appeared to be doing, people were doing things well. And if you hit the next page, Paul, the idea that sparked our interest in doing some things a little bit differently came from two big schools, Harvard and Yale. I was fortunate enough actually to do my undergraduate on the top left school at Harvard. My hockey and lacrosse skills helped me get into that school. I came out, and when I came out, I knew nothing about. I still didn't know anything about investment management in those days, and I certainly didn't know the size of their endowment funds. Harvard has an endowment fund. I think it's about $35 billion right now. Yale is about $25 billion. The annual budget of those schools are being funded. Sometimes 25-30% of their annual school budget comes from these endowment funds. So they've been in existence for over 100 years. They have a long experience in managing large sums of money. And people started noticing that they do things a little bit differently than your traditional stock bond portfolio. The other one is closer to home, is teachers. There may be people in this room that either are getting a pension from them or will be, or know someone. I'm quite sure. Teachers' Pension Fund, the Ontario Teachers' Pension Fund is about $155 billion. It's one of the largest pension funds in the world. And until 1990, they were only invested in government bonds. And very quickly, by the time we started looking at it in 2004, 2005, they were acknowledged as being one of the most sophisticated investors out there. So what did we take from them? We looked at them. They had excellent returns, but sometimes excellent returns comes from people that are taking a lot of risk. But somewhat surprisingly, their returns on a year-by-year basis were extremely stable as well. Markets were going up and down, and they were consistently showing 11-12% annual returns. And how were they doing it? They were the ones that sort of introduced the world to what is now affectionately known as an alternative investment. At the time, 2005, when you said, what's an alternative investment, people would look very puzzled. But basically today, when we talk about alternatives, the simple definition would be it's not a stock and it's not a bond, it's an investment that is something else. So traditionally, and especially with these players here, real estate would be the simplest example. And teachers, for example, their subsidiary is Cadillac Fairview. So the shopping mall in London and Kitchener, if you go to the TD Centre or the Eaton Centre, that is all those properties physically belong to teachers. So we just skipped ahead. Maybe it went automatic. Sorry. But so they invest in real estate. They invest in airports. They invest in commodities. And they even invest in the dirty word, the hedge funds. At the time, and it still is in some areas a dirty word. But basically, not stocks, not bonds. And the big advantage that they saw, and that was proved, was that those asset classes don't move the same. Their ups and downs don't move as stocks and bonds do. So the jargon would be they're uncorrelated. And the beauty of that is that it allows the power of diversification to work. And so the next page was, please don't worry about reading the small print. It's not meant for that. This is meant to show you year by year, starting from 2006 out to 2014, every color represents a different asset class. So we've got US bonds, Canadian T-bills, Canadian bonds, global bonds, high yield, US equity, Canadian equity, global equity, and foreign equity, and emerging market equity way up top. And the point of this was, if you can see a pattern in there, you're much smarter than me, because to me it's a mosaic. You don't see anything in there, and that's sort of the point. Emerging markets in 2006, 32%, and you're like, wow, we got to have some of those. And sure enough, the next year, it's still the top performing. But then what happens? Boom, minus 41%. And the point is, there's no pattern in there. What does very well one year, sometimes it continues to do well for a year or two, but often enough, the high flyers become the losers, and other things are moving, and it's almost impossible. I think it is impossible to discern any kind of pattern in there. So then we come to think, is there a way that you can put things together and make it work for you? And in fact, there's a gentleman called Harry Markowitz who won the Nobel Prize back in the 90s based on a lot of mathematical theory that said exactly that. Yes, the beauty, the free lunch of the investment world is that with diversification, if you put different pieces together that are uncorrelated, they can be somewhat correlated, but as long as they don't move exactly the same, you can put the pieces together and get the same return as one of the individual boxes with much less risk. So it was a way to build an optimal portfolio. Basically, you choose your level of risk and you will get the best return possible, the safest way. And that is sort of the power of diversification. I think if you go to the next page, I come back to my honeycomb and say, well, that's exactly what we're doing. We're putting together, is it 12 or 14 little hexagons there? Those are, if I look at the Mac basket today, those are the identifiable asset classes that I can say are present in the Mac portfolio. So the Mac portfolio, I forgot to mention at the beginning, its mandate is to be a balanced portfolio. And our benchmark that we measure our performance against is 60% equity, 40% bonds. That is sort of the traditional, slightly growth-oriented, balanced portfolio. And we always promise to be fully diversified in all the major countries of the world, and be diversified by style, be diversified by large, small. We want to have a little bit of everything, because that's where the real power of diversification comes in. So that was the idea behind it. How has it worked? I think the next page you will see in black I've inserted the map. And we never promised to be the best, and we're never the best, although in 2010 we were pretty close. But more importantly, we're always far from being at the bottom. And that's, we have our down years too, when both stocks and bonds are being hit hard. We're going to have a negative year as well, but it's never going to be as bad as if you had a highly concentrated portfolio and only did one or two asset classes that you thought were the best based on a previous year or a previous couple years. So I think this really shows the power of diversification and what our portfolio management is all about. Yes?
If you're saying that there is very little correlation between the pieces and all these different asset classes, and one year could be up, but the other year down, and so on, how do you then decide what becomes part of your ETF if there's such unpredictability?
I think in the short term, it's 100% unpredictability, but I think longer term, then some trends based on valuations can come to light. And when I get into talking about our market outlook, I'll certainly share what our views are on the market. But our point is, even if we like, as we do right now, stocks more than bonds, and even though right now we like Europe more than US, our point is we're never going to go 100% in one or two asset classes. Even if we think medium term they could do better, we always want to keep a little bit of everything to make sure that, in case we're wrong, that the volatility is kept under control. So it works its magic by just having a lot of different asset classes that are uncorrelated. One problem is, and we saw it in 2008, what the numbers showed was that all these things were uncorrelated, but when there was a major 1 in 100-year crash, all of a sudden the correlations all went to 1 in a sense. Everything that was risky went down just as much, even though, historically it never moved one for one. All of a sudden, in a major correction, it didn't work as good as we would have liked, and a lot of, and we were hurt along with everybody else, but it bounced back very nicely, once the dust settled after that 1 in 100 year event. So if we keep going, this is a joke, by the way. This is not the end. This is my first slide on what I came here to talk about, which was to share our market overview. But and don't look at it too long because you'll get a headache. But there is some reason behind the sanity. We were asked by several people, it would be great if you could have one slide and just give us, where things stand. And that is a good idea. But then we started thinking and jotting things down. We are global asset allocator type managers, so we need to talk about what our views are on inflation, what monetary policies are doing in different countries, what the economy is doing across the globe. We have to talk about the markets, but not just the Canadian market, but because we invest in the US and Europe and Japan. And when we put it all together, that's a lot of variables. Can be summed up very simply, and that's in the middle. We like stocks more than bonds right now. Bonds valuation are not attractive, and we will get into that. And a big important part of it is that unfortunately we think volatility is going to come back and rear its ugly head because if we believe, and we do, the U.S. Federal Reserve, the U.S. Central Bank, is going to start raising rates in the not too distant future. And they haven't raised rates in something like 9 years, so it's an event we haven't seen in quite some time. But historically, it's never usually good in the short term for various markets. So that's one thing we're very conscious about as well in the way we manage. So let's get into the overview. One of these things is not like the other, and that's simply talking about the U.S. Central Bank. They have promised to start raising rates. A lot of people thought at the beginning of the year it was going to be already by now or June at the latest. It looks like because the first quarter was a bit slower in the U.S., their economy, that things have been pushed back, and now we're talking more the fall or maybe even as late as December before that rate hike finally comes. But it is definitely coming. And what's different about it this time is that they're talking about raising their rates, and every other central bank in the world is talking about easing even more. I mean, the Bank of Canada surprised everyone in January by lowering the rate from 1% down to 0.75%. And Europe, not only have they brought rates very low, and if you show my next slide, they've gotten so low that we have something called a negative interest rate, if you can believe it. I can hardly believe it. And this guy has two heads. Basically, he's somebody that bought a negative 10-year bond. So he's invested today, which you could do. In fact, 3-4 weeks ago, Switzerland became the first country in the world that issued a 10-year bond to investors that paid a negative interest rate. So it's like you are investing in a 10-year bond guaranteed by Switzerland, and you have to pay them to own that bond. It makes absolutely no sense. And that's why I'm saying, what are all these people that are buying these bonds? And so that's a 10-year. German bonds 10-year bonds were down to 0.1%, and in fact, German bonds up to about 7 years were also offering you these great negative returns. And so there's many questions that need to be asked, like why would anybody do that? You could say, well, maybe a Japanese investor was happy to earn nothing and actually pay because he thought the currency would appreciate, maybe that's it. But really, there's also this fear factor that, well, I'm only giving up 0.1 or 0.2%, and maybe in 5 years, and that's this guy here. He's bought a negative bond, and then maybe 5 years later he can sell it at a profit because rates are even more negative. But my guess is he's going to be really the guy on the left side of the slide. He's going to be saying, what were we thinking? I mean, what were we thinking? Why, as an investor, would I lend my money to a government and actually have to pay them for the privilege of lending? It makes no sense to me, and I think eventually common sense will prevail. And bond people that have invested not just in Swiss and German, but in Japanese and probably Canadian and American bonds as well. If you take a longer term time horizon, there's many, especially longer term products that just don't seem to make a lot of sense to us right now in the fixed income bond market part of the world. So if we hit the next page, what are we doing on fixed income? Because it still remains a large part of the portfolio, even though our benchmark is 40% bond and we're very underweight. We're only at about less than 30% in terms of bonds. We still want them because the benefits of diversification will play out. But we do want to earn a little bit of, we certainly don't want to pay them. We don't want to have a negative yield. We do want to earn something. The quote from Mark Twain was, why not go out on a limb? That's where the fruit is. It makes a lot of sense. We know as investors that if you don't take any risk, you're not going to have any return. But we want to balance that risk. So the two ways that typically you can get more yield is with duration. So buy longer term bonds because they pay more. The flip side, though, of course, is if rates start going up, they're the ones that are going to be impacted the most. So we don't like that. We are actually shorter. If you compare the average length of the underlying bonds that we own through the ETFs, they're going to be shorter than the benchmark would be. But we could take some credit risk. That's another area. Instead of buying an Ontario or a Government of Canada bond, well, we can buy some quality bank bonds, insurance company bonds, only investment grade. The other area where we could get even more yield would be so-called junk bond or high yield bond, where there's companies that need money that you can invest in, but they're unrated, meaning that the quality is not going to be there. Can be very interesting, but we think right now with rates so low and with the US Fed telling us that they're going to start raising rates, we think that the lower quality stuff would also potentially be hit on a first go around once the US Fed starts raising rates. So that's another area we've simply eliminated. So one other consequence of the US starting to raise rates while everyone else is keeping rates very low is currency. And we have in our portfolio a lot of exposure to the US dollar, not only through our holdings of US equities, which are in US dollars. A lot of our alternative investments like gold are priced in US dollars. We have an ETF that is a global infrastructure ETF, so it invests in infrastructure products globally, but it's also priced in US dollar. And then what we've decided to do, because we think this is going to continue quite a bit longer, we've actually bought some Japanese ETF and a European ETF, both that are hedged back into US dollars. We would have liked it in Canadian dollars, but our market is not big enough, and so there's not enough, they're just not available. So we're sort of being forced, because we don't like the currency of either the yen or the euro, sort of being forced a little bit into the US dollar. And some people have told us, wow, the dollar's been quite strong the last couple of years. Don't you think you should be careful and get rid of some of that US dollar exposure? And we show them this graph. And it's basically the US dollar index. So it's the US dollar against a basket of currencies going all the way back to 1967. And what is interesting, and the conclusion that is drawn from it, as mentioned by the Rolling Stones, time is on my side, these cycles go a long time. On average, 8 years. So the up moves or the down moves of the dollar on average have lasted 8 years, going back all these years. And so the last blip that you see on the far right of the dollar starting to strengthen, the US dollar I'm talking about, is really, if this holds true, we're much closer to the beginning than the end. And currencies tend to overshoot. And so for all those reasons, we think the US dollar is going to continue to be strong. And that's one of the investment themes that we have adopted since day one. And I forgot to mention it, but when we got introduced as the new portfolio managers of the Mac Basket back in January, I remember doing a presentation, a conference call with all the investment advisors. And I'm happy to say that all the investment themes that I gave them back in January are 100% identical from today. We are not short-term traders. I mean, in the meantime, oil went from, going back a few months, it was at close to 100, all the way down to 40, and now it's bounced back to 60 in the space of a few weeks. We don't care. We've been bearish on oil, and we're not there to we don't think we're good enough, and we don't think anybody's good enough to catch those, speculative moves that last a few weeks. We're happy to leave that to the speculators. We're taking positions based on at least 6 months, if not a year or 2 years. So, it worked out that 6 months later, I didn't have to change my presentation that much because our investment themes are still holding true. Yes, please.
Do you think the U.S. dollar is in any trouble because of the amount of money they printed, the size of the U.S. deficit, and the amount of debt that's held by Russia and China?
A very good question, which actually leads me, I can answer your question by continuing on the presentation, in fact. QE, quantitative easing, it's a term that is thrown around a lot in the financial press. And what it entails is, we know traditionally central banks have manipulated the short-term overnight lending rate. And that's, the Fed has brought it down to 0, and Bank of Canada brought the overnight rate down to 0.75. Traditionally, that's been the rate that they've used. After the crash of 2008, they wanted to do more. And what they did, they came up with quantitative easing, which is a way, some people call it printing money, and it's debatable. It becomes very technical how you define it. But basically, the U.S. Central Bank started purchasing longer-term bonds, so 5-year, 10-year, and 30-year bonds, with the goal of raising the price of those bonds and bringing down the interest rate, not only of the very short term, but also of the long term. And I guess only time will tell if it was been successful, but it has been successful at least to the extent that 2008, when people were saying this is the next great recession, turned out to be a very bad recession. And we've had slow, steady improvement ever since. And how much is due to the work of quantitative easing, I guess, is going to be left to the historians. But the reason I don't fear the U.S. dollar and what they've done is because Europe is doing the exact same thing right now. And in fact, if you look at it relative to the size of their economy, what Europe has just started doing this year in terms of printing money and buying bonds is actually larger than the U.S. And Japan is several times larger in terms of relative size to what the U.S. is doing. So currencies, you could make a lot of arguments that the U.S. dollar should be a lot lower, but the problem is it's sort of like, it's the best of the worst, so to speak, because the other countries have just as much debt, if we're talking Japan or Europe, as the U.S. does, and they've been printing money just as much, if not more, than the U.S. So on a relative basis, in currencies, it's always one against the other. I still think that my earlier slide will hold, and that the trend will continue higher for the U.S. dollar for those reasons. Mr. Jenkins.
Those of us with best before dates of, fairly current best before dates in the audience, wonder about the Chinese efforts to dethrone the U.S. dollar as a reserve currency,
Yes.
setting up an equivalent to the IMF, trading with Russia and yuan. How effective do you think those things will be, and should we be worried about it in our shelf life?
It's hard to say the timing. I don't see that being a major consideration in the foreseeable future, meaning 2, 3, 4 years down the road. I think we have to go through probably another major upheaval at some point, and then see how China's been able to gain market share in terms of having a reserve currency. I know they would love it, and Russia would love it, but the fact is that when times become difficult, people are still moving, and I think will continue to move towards what they knew in the past, and that was, the U.S. dollar or the Swiss franc or other more traditional safe haven currencies. But eventually, economic size will dictate, and given how fast and how large China now is, that is definitely something that's going to happen down the road. But I don't think we need to fear it. why not just, if you can't beat them, join them? And so we can start investing in those countries as well. We jumped over. I'll finish this slide very briefly. We like the US dollar, but because of quantitative easing, while the US was doing it, their market was booming ahead. It's been the best performing market over the last 5 years. Now that Europe and Japan have gotten serious, we think their markets are going to do better than the US on a relative basis, but their currencies are not. So if the simple example is if I invest in Japan and I make 20%, because the Japanese market is up 20%, that's good. But if in the same time period the Japanese yen is down 20%, once I convert my profits into Canadian dollars, I've made zero. So we think there's a time and place for strategic hedging, and we think now is that time where we'll take the return of both Japan and Europe, but we will protect ourselves if those currencies go down. This was something that was not available back as early as 10 years ago. Now it's become widely available. And the chart on the right, basically, I don't think we have to go into it, but it's basically saying that the exporters of countries that have a depreciating currency, I mean, Canada always, that was Jean Chrétien's thing at the time, low currency is good for the country because it helps our exports. But nobody ever got rich by devaluating to zero, so you have to have a little bit of a balance there. But it's true that if you have a cheaper currency, at least in the short term, your exporters are going to do well. And we know that Japan has a lot of big exporting countries, Europe has as well. And the chart on the right was basically saying that, it's the exporters that have done well over the last 6 to 1 year, and it's partly because their currencies have been weak. So we're playing all those themes that all interrelate with central bank movements, currency movements, and trying to fit it into what we're doing into our investments. Another question, please.
Just quickly, why does the U.S. Federal Reserve feel compelled to raise rates?
That's an excellent question. I wish I had the inside information as to exactly why, but we can certainly speculate, and I think it's because they're afraid, and I think for good reason, that they can't control the business cycle yet, as much as they would like to try. Eventually, the U.S., just because the economy is going to run out of steam naturally at some point, is going to fall into a recession once again. And if they've kept rates at zero throughout the whole expansion, and we then fall into recession, what are they going to do? Their ammunition has always been to, balance interest rates. And once the economy goes into a recession, their first tool has always been to lower rates. But once you're at zero, that is sort of they're stuck. They're stuck between a rock and a hard place. So even though they know inflation is not a big problem, a booming economy is certainly not a big problem. We've had steady growth, but not spectacular growth. I think they want some ammunition, i.e. they would like some higher interest rates to be able to lower it if need comes. I don't think they'll move a lot because, and that's one of our other, I don't have a slide on that, but one of our other themes is that inflation is just not a problem anywhere. So I think it's going to be a gradual and moderate move when they start doing it. My last slide here in terms of themes was, it looks like your Jeep stuck in the mud.
Right in the weekends.
Probably the biggest reasons why we're not in love with the Canadian market right now, even though we still have a large position in Canada, is because our stock market is still so linked. Until a few years ago, 50% of the Canadian stock market was in commodities, either energy, oil and gas, or materials, copper, gold, you name it. We have a stock market that's well known to be highly influenced by the resource sector. And right now, we just don't think there's a compelling story on the resource sector. The big one being energy. Yes, we've seen some volatility in oil of late, but if I would have to project a forecast over the next 12 months, I think we're going to be pretty close to this $60 to $70 level. I really don't think we're going to go back up to $100 in the medium term. I think there's still a lot of supply out there. I think if you look at the numbers on the amount of oil shipping ships that are full to the rim, just waiting to dump their oil on shore, you would see that at least for the next foreseeable future, even though a lot of the expansion in the oil sands has been brought to a halt, and even though a lot of the new production in the U.S., the so-called shale revolution, has been cut with the drop in oil prices, I still think that there's enough oil out there. And one little anecdote would be, yes, there's a lot of rich people that will drive some Teslas, and a few other people that can afford it as a second car will have a Prius, but you don't even need that anymore. I rented, and I've been going up the 401 the last few days in a small Hyundai with a 4-cylinder, and because I drive a big truck back home too, that I know about bad gas mileage, but I couldn't believe it. I mean, I was keeping up with the flow, not speeding, but I see that in Ontario they've gotten the Quebec disease where everyone goes 130 now on the highway, and my average fuel was at 5.5 per 100. I couldn't believe the gas mileage I'm getting. And so the point is, we continue to use less and less oil, and it's going to happen even in China. Even their dramatic growth phase of building all the infrastructure is behind them. China slowly but surely is going to convert into a consumer economy like we have here in the West, and that is going to demand less oil and energy in the future as well. So I think all those factors tell me that just like the Stone Age didn't end because we ran out of stone, the fossil fuel age is not going to end because we've run out of oil. I just don't see it spiking a lot higher. In fact, I wouldn't be totally shocked if we had one more down move on the oil in the short term. So that's sort of the lay-in why we're not overly in love with Canada. And I think that gets to my final slide, which is just basically a snapshot. If you looked at the way we're positioned right now in the multiple asset class portfolio, is we are quite underweight on the fixed income, on the bond side, for all the reasons I tried to explain. Canadian equity, we're a little bit underweight because we don't have a strong story on the commodity side. What we do like is overseas on the equity side, Europe, Japan, although with the caveat that we don't like their currencies as much, and that's why we think it's best played by hedging that currency risk. And then on the alternatives, we would like to have some more and some better ones, but as I said, because a lot of the ETFs are priced in US dollars, and because we have so much already in the way we're structured, we're holding off a little bit. But if we find, we're continuing to look for non-correlated, non-traditional assets, and as they become available, those are always the first things that we're trying to review on a day-to-day basis. So that is the presentation in a nutshell. Happy, I will be here all evening joining you, so please, if there are any questions that you don't have here, you can come up to me at any time. I promise to bring the returns. I don't like bragging about the returns, and of course this is the historical returns of the product, and as a firm that I'm representing here today, I can only take credit for the year-to-date performance, but it's been exceptionally good. We're up 6.8% as of the end of May, and for a very low-risk, highly diversified portfolio, we think that's a great return because, in fact, since inception, we're only averaging about that on an annual basis. So after 5 months, it's been a very strong return. We've done quite a bit better than the benchmark. And I don't have the volatility numbers for this year. Unfortunately, volatility works both ways. If you do very well, sometimes short-term, the way it's measured, your volatility is going to move up a bit. But I'm quite sure that if we're delivering very good returns, if we have a little bit more volatility, nobody really cares. It's when we underperform with higher volatility, that's the one thing that we never want to show to our investors.
I'm going to jump in. Ralph, that was fantastic. We got a whole night in front of us to